From a financial perspective, one of the best parts about being retired is that you can control where you take your income from and how much taxes you pay on it as a result. During your working years, you get a paycheck from your employer. It's taxed as ordinary income, and there's nothing you can do about that. But by the time you've retired, ideally you'll have multiple different types of investment accounts that all have different tax characteristics. So in this video, I'm going to show you how you can pay yourself over $100,000 and not pay a single dollar in income taxes. And by the way, none of this strategy includes a Roth IRA. Hey everybody, if we haven't met yet, my name is Jake Skellhorn. I'm a certified financial planner and co-founder of Spark Wealth Advisors, where we give you the confidence and clarity that you deserve with your money. If you're enjoying this video, be sure to like and subscribe to my channel here and share this video with a friend if you think they could find it helpful. So let's dive in and take a look at the example. All right, so here we have our clients, Jamie and Sam. Their names have been changed and some of this has been simplified just for the purposes of the video. But the green accounts here are their retirement savings. So Jamie has a Roth IRA, traditional IRA. They have their joint bank accounts. They have a joint taxable brokerage account with $300,000. The cost basis on that is $150,000. So if you're not familiar, long-term capital gains apply to any assets held within a brokerage account if you've held it for more than a year. So for every dollar that they take out of this account and sell investments, 50 cents of that is going to be a return of principal, which is not taxable, and 50 cents would be considered long-term capital gains, which are taxed at either 0, 15, or 20%. So that's why I showed the cost basis there. And then Sam has her accounts over here, 403B and a rollover IRA from a previous job. Their goal is to live off of $8,500 per month in retirement. They're already retired. They're receiving Social Security that we'll pull up in a moment, but $8,500 multiplied by 12 is $102,000. And their current Social Security benefit is $2,200 a month for Jamie and $2,500 a month for Sam. So really quick, let's just see how much they need to liquidate from their portfolio in order to support that lifestyle in retirement. And within the brokerage account, we're also going to assume that the investments spit out dividends and interest. So we're going to assume about $6,000 per year in qualified dividends and $4,000 in interest from any bonds or other investments in the account that pay interest. Okay, so if we take their Social Security benefit, which is $4,700 per month, that's $56,400, and they receive that $6,000 per year approximately in qualified dividends, plus $4,000 in interest. $66,400 is what they have from Social Security, interest and dividends. That's kind of their income floor. So to reach $102,000, they'll need another $35,600 from their portfolio. Now remember, they have all these accounts that they could pull that money from. They have Jamie's Roth IRA, traditional IRA, they have the bank, they have the taxable brokerage account. So let's pull up a tax report first to see how their income stacks up so far and where they can pull that remaining $35,600 from to meet their living expenses in retirement. All right, so let's plug their numbers into our tax planning software here. So starting with income, they have no wages. Obviously, they're already retired. They have their taxable interest from their taxable brokerage account on the bond funds in there, $4,000, like we said. There's $6,000 in qualified dividends. Here's their Social Security. Here's their taxable Social Security. If you're not familiar, Social Security is taxed based on your provisional income, which is going to be your adjusted gross income plus half of your Social Security benefit and any non-taxable interest, which they don't have in this case. But I'll pull that number up on the screen just so you can see where you might fall in those brackets. All right, so here's the preliminary tax report for Jamie and Sam. Over here you can see their Social Security income and how much of it is taxable. They have their qualified dividends up here, and they'll just be taking the standard deduction here, nothing crazy that they have to itemize. So far you can see that they owe $0 in taxes, so they don't make enough in other income for their Social Security to be taxable because they have the standard deduction here. So let's go back and see where we can add income to keep their taxes at 0, but also increase it to where they have that $8,500 a month to live on. So if you remember, for every dollar that we pull out of the taxable brokerage account, 50 cents is going to be non-taxable because it's just returning what you paid for the stock or the investment, and then 50 cents will be considered long-term capital gains. So if we take that $35,600 all out of the taxable brokerage account, half of that would be considered long-term capital gains. So $17,800 would be considered capital gains, even though they're pulling out that $35,600. So let's go ahead and add that into their tax report here. All right, so we've added their long-term capital gains that they would realize from selling that stock in their taxable brokerage account. Let's run the tax report again, and we can see that they still don't owe any taxes. So their reported income has increased. As you can see, a little bit more of their Social Security is brought into the taxable brackets because the capital gains still count as income, even if they're not taxed. But as you can see, they still owe $0 in taxes. And the reason for that is because as a married couple, you can have an adjusted gross income of up to $94,000 per year before paying a dime in long-term capital gains taxes. So from here, what we would say to Jamie and Sam is, look, you've already satisfied your basic living expenses. You still have an opportunity to do a couple things here. You can do what's called tax gain harvesting. Since they still have plenty of room within this 0% bracket, they can actually purposely sell more of their investments and then just repurchase them to keep them in the account, but increase their cost basis so that later when they do need to pull that money out for income, their cost basis is even higher. So for every dollar they pull out, maybe 75% of it is non-taxable and only 25% of it is taxable. So that's one thing we could go back to Jamie and Sam to say, look, not only are you paying $0 in taxes this year, but you could save yourself taxes in future years. The other thing we could do is suggest a Roth conversion. Since they don't owe any taxes right now, they're likely able to do a Roth conversion without owing another dollar, at least a small amount, so we could run the numbers on that for them. But so just like I said in the beginning of this video, being retired is great for being able to pick and choose which accounts you pull your income from. If you want to keep your income low during a specific year for whatever reason, you can do that. Ideally, you'll have that taxable brokerage account built up to take advantage of those long-term capital gains rates. But the goal here usually is to minimize your taxes over the course of your life, not just one particular year. So in Jamie and Sam's example, that taxable brokerage account will of course run out eventually, and they'll be forced to start taking money out of those pre-tax accounts. So we may run some scenarios with them where they take a small withdrawal from the IRA, convert some to Roth to pay taxes now and less later, whatever it might be. But if you found this video helpful, be sure to subscribe to the channel here, leave a comment below, and share with a friend. Thanks for watching.